Good evening, friends. We welcome you all to our quarterly investors call. It's a pleasure again interacting with you. Friends, today is a very auspicious day where many festivals are being celebrated across India. They are called maybe Makar Sankranti, Lohri, Pongal, Bihu, and so on and so forth. We wish you all happy festivities, and we also hope that the time ahead will be much better for all of us. Friends, we are passing through, as we all know, very challenging times of Corona, now Omicron. We hope and pray that all your near and dear ones are safe and healthy. And we also pray to God that these challenging times should get over soon. Moving on to some good news. CY22 has begun on a very good note for us. Two leading magazines, two leading media houses have recognized our efforts, have recognized our performance. So one is Silicon India, from India, this magazine. They have rated Alpha Accurate Advisors as one of the top 10 PMS providers in India for 2021. Similarly, a very reputed magazine and media house in Asia Pacific region called APAC Insider, with headquarters in UK. They have rated Alpha Accurate Advisors the only PMS in India for 2021. Friends, this has been possible with your continuous support, belief and faith in us. These kind of awards or accolades keep us continuously on our toes and encourage us to perform better and better for you and for everyone. The journey which we started 12 years back, we hope and we pray that we continue on a much better note going forward. Moving on, I'm sure you all must be waiting to hear and to know about what is in store for us in calendar 2022. What are the investment themes we are playing? What are the mantras for 2022? What's the market outlook? What are the risk factors? To talk about this, I invite Mr. Rajesh Kothari to give us more details and give the views on these parameters. Thank you very much. Over to you, Rajesh.
Thank you, Govind. Good evening, friends. First of all, season's greetings to all of you and to all your family members and well-wishers and friends. I'm sure 2022 will be another year with a good equity market performance and, more importantly, a wealthy and healthy year for all of us. Friends, without taking much of time, let me straight move to our presentation, and bear with me for 1 second. I will just share my screen in a moment. Just a minute, please. I hope this screen is visible to you. Friends, since there are many more number of investors, they came in last 6 months, 9 months, 12 months, just within probably 1 or 2 or 3 minutes, let me tell you a little bit about Alpha Accurate Advisors, a very brief 1 or 2 minutes without taking much time. So as I mentioned in our various meetings, why Alpha Accurate Advisors and what separates us from others is 3 important things. Founders are fund managers. I'm founder and I'm fund manager, so there is no risk of change in guard. We have a client-centric business model from last 12.5 years. One of the few PMS firm in the country with a vintage of 12.5 years with no conflict of interest. And I'm sure all of you would have experienced at various points of time, they are very, very open, and we are very, very available and accessible to all the clients whenever they want for a conference call or for a meeting. And of course, last but not least, we have award-winning track record. In last 12.5 years, we delivered close to 20% compounded annualized returns compared to benchmark returns of about 11 to 12%. And we have received a number of recognition and awards, as Govindji has rightly mentioned. So that's basically what differentiates Alpha Accurate Advisors compared to many other firms. When it comes to our investment approach, we have a very resilient investment approach, market size, market share, and margin of safety. And we buy the companies which are leaders into the sector. And friends, let me tell you, it is that character of buying only leaders which has helped us to protect capital during very, very volatile times of last 2, 3, 4, 5 years. Of course, 2021 was a great year for everyone, but it didn't come without big volatility in 2020. But even 2020, we tried to protect capital as much as possible because of our 3M investment approach. We always believed in delivering superior risk-adjusted returns. So diversification, we are never extreme, 50 stocks portfolio. I'm talking about AAA IOP, our flagship PMS plan, staggered investment approach, and very, very important, we not only focus on what to buy, but we strongly focus on when to sell. Discipline exit strategy remains one of the most important USP at AAA PMS. And that resulted in a number of multi-baggers. I'm just putting a few names: Dixon, Timken, Honeywell, and many more such companies. Let me now directly take you through 2022 market outlook. Friends, we believe there are 3 important investment mantras for 2022. So first and foremost, we strongly believe the equity market as an asset class will continue to outperform. Why we think so? It is because of 3 important factors. So first, the real rates are at a very, very low levels. And it is very, very important, if the real rate remains low, then equity market generally gives handsome returns over a period of time. The real low rates is combined with the strong corporate earnings growth. I'm sure you would remember that India has witnessed and experienced winter of almost 12 years, desert of 12 years of earnings growth. From FY08 to FY21, Nifty earnings growth was muted at only 6%. And we always believe that market is nothing but mirror of earnings growth. And over the next 2, 3, 4 years, we expect earnings growth to remain strong double digit. In FY21, we already have seen Nifty to report 22% earnings growth. In FY22, again, Nifty is expected to grow 20% plus earnings growth. And in FY23, as per Bloomberg consensus, Nifty is expected to report 15% plus earnings growth. So earnings growth is going to remain very strong. At the same time, the corporate balance sheet, the debt is reduced, so ROE is going to improve further. And friends, that is a very rare combination. Strong corporate earnings growth accompanied by low debt equity and high ROE is something very important. And last but not least, the structural reforms is very, very important. And these are the 3 reasons why we expect equity as an asset class to continue to outperform. Whenever I've interacted, particularly in last 5-6 months with investors, investors have expressed concerns that whenever market goes up like this, 20%, 30%, 60%, 80%, there are years when the drawdowns have been significant. No doubts about it. And this is the chart on left-hand side. If you can see on your screen, we have plotted last 20 years data. Every year, there are drawdowns. Sometimes 9%, sometimes 20%, and during Lehman collapse, it was as high as 50%. But the beauty of equity market is patience. If investor has continued to remain invested, despite such drawdown, he has seen the wealth creation of 12 to 13 to 14 to 15% compounded returns over a period of time. In fact, even if one would have invested just before Lehman collapse, his wealth still have reported 10% compounded returns, probably 30, 40, 50% higher than the fixed deposits in India. So despite several drawdowns of 15 to 20% every year, rupees 1 crore invested has become 15.2 crores, as you can see in this chart. So do not worry too much about the market volatility. Equity market by nature is going to be volatile. One can't skip the volatility. Take it to your advantage. So we do not rule out any corrections. Corrections are part of equity market, but we believe one should utilize to take it as an opportunity, to take it to your own benefit, to add to equity as an asset class. And we have seen that even in 2003 to 2018, Nifty went up 5 times in 5 years, 38% compounded returns. But that 38% didn't came just as a linear line. There were 6 episodes when market declined by 18, 20, 30%. Even the diehard bull market fans, they got worried during those times. But because the earnings growth was very strong, market continued to deliver. So there are many investors, they ask us that, Rajesh, this entire rally is driven by liquidity. Is it so? I don't think so. Liquidity always chases the good asset class. Am I right? For that matter, any asset class. Liquidity always chases the opportunity. If the earnings growth is good, if the flower is good, bees will come, honey bees will be there, provided the flower is good. And that's what matters. And if you believe that corporate India to deliver earnings growth, then market will keep delivering you better returns over a period of time. Second important mantra, we believe that 2020 was a great year, 2021 was a great year, but 2022, it might be a good year. It may not be great year. Market cannot give you every year 30% compounded returns, particularly in 2021. In fact, the poor quality stocks have outperformed the good quality stocks. And if you look at this chart, the blue bar is good quality stocks and the red bar is poor quality stocks. And if you put the fundamental characteristics, which I have plotted here on the left side, whether you look at profit growth, whether you look at return on net worth, whether you look at debt equity, on every parameter, the good quality companies have underperformed the poor quality companies, and that too by a wide margin, 20%, 30% difference, 26% difference. In my view, this cannot continue. At the end of the day, good quality companies will start outperforming poor quality companies. So number one mantra, equity will do well, but that doesn't mean that everything will do well. You need to be very, very selective, because as market enters into the high valuation zone, you need to be bottom-up approach. In our view, that would be more rewarding rather than the top-down approach. If I look at our portfolio and if I compare the second quarter performance, because how do you decide whether the portfolio is good or not? And if you look at this, every sector, portfolio company's performance versus the peer group performance. Look at, for example, agrochemical. Our portfolio companies delivered 23% 2-year CAGR. I'm talking about 2 years because 2020 was a COVID year. So I'm comparing with a normal year. You compare this with the peer group, it is only 9.9. Let's look at pharma. Our PMS portfolio companies delivered 20% compounded growth. Peer group reported only 2.5% compounded growth. Let's look at engineering. Our portfolio companies delivered 12% compounded growth. Peer group reported only 0.7, almost 0% compounded growth. So across the sectors, our portfolio companies have rightly positioned to benefit from the global recovery. They benefited from the consolidation in the sector. They benefited because of their lean balance sheet. They benefited because they could manage the supply chain, which went havoc, particularly last 12, 18 months. And it is because of that characteristics And if I connect the dot, I talked about market size, market share, margin of safety. We buy only leaders. This performance of these companies would not have been possible if these companies would not have been the leaders. It is because their leadership position with a strong balance sheet and strong market share, they keep gaining more and more market share. They kept identifying more segments and they kept entering into the new market, which resulted into the better revenue growth and better operating profit growth. Third, very important, harness active investment management. This is going to be very, very important. Friends, in last 18 months, whosoever bought, everything went up. Even the traders and the tip makers, probably they made more money than smart money managers. And if you buy and just hold on over a period of 5 years, 2 years, 3 years, that was the story long time back. But I'm sure all of you would agree with me that in last 3 years, in particularly post IL&FS credit crisis and then different reforms and then the COVID crisis, the sector rotation became very, very important. So what to buy is important, but you need to sell as well. The discipline exit strategy is something very, very critical. So where are we currently in terms of our portfolio exposure? Well, banking and finance is number one exposure, 25% of the portfolio, still lower than the benchmark weightage. BSE 500 is roughly 30% portfolio. But from here on, we are positive on banking and finance. Within that, we believe it is a winner takes it all approach. So we are holding all the number one, number two, number three players in the industry, the best of the institutions like HDFC Bank, ICICI Bank, Bajaj Finance, Chola Mandalam, State Bank of India. This is what we own in banking and finance. We believe that the sector is not yet out of wood. It is not that economy recovery right now is running on full throttle. It is going to take some more time. But from last 3, 4, 5 months, incrementally, we are becoming positive. The valuations are in your favor. The asset quality issues are behind you. The credit cost worries are behind you. As the recovery progresses, we believe banking sector will also do fundamentally better compared to what we have seen in last 12, 18 months. Second important sector is consumer, roughly about 17% of the portfolio. But friends, we have changed the composition significantly compared to what we used to own 3 years back. 3 years back, we used to own more defensive companies. It means more of Hindustan Unilevers and more of Nestle's and more of Britannia's, defensive companies. But today we are holding more of discretionary companies. So we are holding companies like Titan, companies Asian Paint, and so on and so forth. Very importantly, real estate is one sector on which we have been bullish. Even in last conference call, or probably 1 year back conference call also, I talked about it, that we are bullish on real estate. But because of the balance sheet issues and various other risk factors, particularly from the government side, we don't have many companies in India which one can bet on the real estate sector. And therefore, we are buying the companies which are proxy to real estate without taking the risk of real estate. What I meant by that? I'm talking about building material companies. So we are holding number one company in plywood, which is called Century Plywood, since last long time. Stock has almost probably doubled from our purchase price. We are holding the largest company which is into tube making company, which is APL Apollo Tube. We are holding the number one company in wire and cable, which is called Polycab. We are holding that, and so on and so forth. So roughly about 5 to 6% of the portfolio is a proxy to real estate. What is good about this portfolio is that on one hand, we are taking zero risk on the balance sheet because all these are consumer franchises. So they are actually very strong B2C businesses. No, you are not taking any balance sheet risk. You are not taking any governance risk. And at the same time, they will grow not only because of real estate, but they will also grow because of the consolidation in the sector. Say, for example, in pipe sector, there are 3 to 4 organized players. They actually closed down during last 2, 3, 4, 5 years. Companies like Kisan Molding and many more such companies. And that naturally benefited companies which we used to own in our portfolio, and the stock price almost became 4 times, and we made an exit on a recent times. So building material is one sector on which we are really positive, and we hold roughly 5 to 6% apart from other consumer discretionary. Capital Capital goods is one sector. I've been talking about it from last almost 5 quarters. We have been bearish on this space for almost 8, 9, 10 years. Is only from last 4 to 6 quarters we have been talking about capital goods. We are a little bit early in the game. We are holding 12% of the portfolio in capex story. But the composition again is what makes it very unique and very differentiated. Traditionally, capex means construction company, road company, port company, EPC company, irrigation companies. We are not holding any of this. We are holding the companies which have a technology as a moat in capital goods. We are holding the companies which are not only going to benefit because of the government spend, but they are going to benefit because of the brownfield to be done by corporate India. Greenfield may take some more time, but brownfield is already happening. These are the companies which are into automation. These are the companies which are into robotics. These are the companies which are there to improve your processes. I'm talking about companies like Eevee, Honeywell, 3M, Timken, Cummins, KSB Pump. These kind of companies what we own in our portfolio. These companies have zero debt on their balance sheet. They are the best of the technology available from their parent company. They are known globally for their research and development. They are known globally for the new technologies and also the green technologies and also the sustainable solutions. Let me give you one example. ABB India, one of our portfolio company, implemented the largest conveyor belt for JSW Steel in Karnataka. And by doing that, they saved 3,000 road trips, which otherwise a truck has to make to move the material from mine to the factory. So it is not only about giving a solution, but it is about giving a green, sustainable solution to the company. So that's what I meant by capital goods. We are holding roughly 11% of the portfolio in that. Software, we are positive on this, is a mixture of large cap and mid cap and small cap. That's what we own in software. Specialty chemical, we have been early identifier of this sector from last almost 4 years. We continue to remain very positive. And in fact, in today's session, we have devoted 10-15 minutes only for specialty chemical, and I will come to that within next 3-4-5 minutes. And others are automobile and auto ancillary, on which we are positive. Pharma is roughly 3-4%, and others 7%, and balance is cash. So this is how currently we are positioned from the portfolio perspective. Let me talk about 3 themes on which we are positive in 2022. The first, continuation of our earlier theme. The big is becoming bigger. Not only bigger, they are becoming better. Bigger and better. And this is happening across the sectors. I'm just giving here the 4 examples, like bank credit. The top 6 players, incrementally, they control almost 70%, 70% of the industry. If you look at cement, 100% of incremental volumes comes from top 5 players. If you talk about steel, top 6 players, they contribute 95% of industry volume. If you talk about car industry, everybody knows Maruti is, of course, the largest player. And I'm not talking only these 4 sectors. There are many other sectors where data is not available, but the consolidation has been much faster. For example, wire and cable, tiles, plywood, pipes, and many more such sectors. Logistics is one sector where consolidation has happened tremendously in last 9, 12, 18 months, particularly after the COVID crisis. So big is going to become bigger, big is going to become better. If you are buying a portfolio of the companies which are oligopoly or duopoly, and that's kind of company what we buy in our AAA PMS, they are really resilient, they are ready to grow, they are ready to expand into the existing segment. Many of our portfolio companies, they have entered into their nearby markets, nearby segments to further identify the growth opportunities across the new verticals. So that is the first thing. Big is going to become bigger. Second, I talked about the capital expenditure revival. And while the debate is still on that whether the capex is revived or not, if you look at the announcements made by number of companies, particularly cement, steel, non-thermal power, then the capex announcement already work in progress is 7,500 billion over next 3 years compared to 3,200 billion in last 3 years. I'm talking about a more than 125% increase in capex. This is the already announcement capex. You add to that the PLI capex, which is roughly about 1,50,000 crores, and there are more PLIs in pipeline. It means more of that we are going to see. If you add to that the many other the new technologies which are coming into India, and therefore capex related to that, whether it is semiconductor, whether it's Eevee, then figure becomes much bigger. So we are in the camp that capex is going to revive. Yes, it is going to take some time. We know that GDP is still not like we are not in the fourth gear, but market is always ahead of time. So we are a little bit ahead in the game, and it has been a rewarding journey to be a little bit ahead in the game. Last but not least, China plus one. We talked about it from last almost now 2.5 years. India market share across different segments is significantly lower compared to China. And even if there is a 4, 5, 10% shift from China to India, it is enough for our portfolio companies to grow their earnings, to grow their revenues, to double their revenues and earnings over the next 3, 4, 5 years. So that remains very big opportunity. Sorry. With that, what I would do is that I would end here, and obviously the important questions in everybody's minds are that, okay, fine, everything is good, but what about the risk factors? And in last particularly last 40 to 60 days, I'm sure everybody has more reading about the Fed increasing the rates globally. Inflation is inching up. It is becoming much more stickier compared to word transitory. In fact, Fed has removed the word transitory from its minutes. So what is in store for us from the risk perspective? How do we see these risk factors and its impact on equity market? And I will ask Govind to touch upon it briefly, and then we'll come back for the next session. Govind?
Thank you, Rajesh. So friends, the equity markets, as Rajesh showed you, are volatile. Some or other factors come into play that which brings down the market, either 10, 15% or even more, depending upon the event. So currently there are 2 or 3 big questions or risk in the mind of investors, which we keep hearing from them. So number one, which comes to our mind, is clearly the inflation, which is very, very high in US, is 40 years high, is running at 7% in US. In India also, it has moved up from low single digit of 1-2% to now 5.5%. So how inflation is likely to impact the equity markets? Number 2, of course, the interest rates, and third is the rollback of the liquidity in the US and the global markets. So first, I will talk about the inflation. As you can see from this chart, I will point out towards 2003 to 2008 period, when the markets became 5 times in 5 years. So if you look at the red line, during this 2003 to 2005 period, the inflation in India was around 4% or 5% only, right? And it started, as economy recovered, the demand started to improve, the inflation also started to move up. So during that 2004 to 2006 time, while inflation was moving up, the corporate profit of India kept increasing. And you can see it moved up from 4% to 6% of the GDP. And in fact, it went up to as high as 7%, more than 7% of GDP. And the markets kept performing. So inflation per se is not an enemy of equities. A moderate inflation is considered as a friend of equity market, and that is where we are in that phase as of now. So whether in India or in US, so this is India. US 7% is definitely very high, is much beyond the Federal Reserve's the target figures. But if you look at in US also, a lot of this is contributed by factors like car rentals and housing rent, etc. Also, if you see the commodity prices which have gone up significantly over last 12 to 18 months, now some of them have started to correct. To give you the names like coal, the international coal prices for last 12 months are in negative zone. They're already down to 20 to 25%. Similarly, iron ore prices are also down 20 to 30% over last 12 months, whether we take 3 months period, 6 months period, or 12 months period. Copper, which is a very important metal which is used across, last 6 months it is flat. So we are already seeing some of the commodity prices, either they are coming down or they are flattening. So with the high base in US and the demand which was very, very high in the US and globally, the demand is also expected to taper off. So incremental inflation in 2022, especially in the second half, is likely to be significantly lower. Having said this, the supply chain issues are likely to sustain at least for next few months, maybe to 1, 2, 3 quarters, which may continuously to feed into inflation. So it is not simply the demand led or supply led, it's more because of the supply chain issue. So just to sum up this part, we believe that a moderate inflation in India is very positive. In US, from high base, the incremental inflation would be lower. So not too much worried about it. Fed Reserve is already targeting to bring down the inflation with the rise in the interest rates and also closing the liquidity panel. Rajesh, can you move to the next slide? So the other big risk or worry among the investors' mind, what happens if the Fed interest rate increases happen? So we have done two periods analysis here. The first period here is 2004 to 2006. As you can see here, the interest rates, US Fed interest rates increased from 1% to almost 5%, right? It's a big 5 times. What happened to Nifty? During this 2 year period, it's not 5, 10 years period, 2 year period, Nifty delivered 95% returns, which is good 30% compounded also, more than 30% compounded, 30-40% compounded. So what it also confirms that the economy was doing well, the corporate earnings were growing fast, hence market focused more on the earnings growth and the equities rather than on the interest rates. Next slide, please. This is the second period, which is more recent, 2015 December to 2018 December, 3 year period. Here again, we saw that the Fed interest rate increased from practically 0 to 2.4%. Yet during this period, market gave returns of 36%. So it is not that when the US Fed rate increases happen, the Nifty goes down into tailspin. These two episodes clearly confirm that. So we believe that while this risks are there, this will increase some volatility. We saw 10% fall in the markets around a month back or so, but which has quickly recovered. So we are not so worried about the US Fed policy stance as of now. That's it from me, and over back to you, Rajesh.
Thank you, Govind. Friends, now we move to the interesting part of our presentation, and that is a deep dive in Indian specialty chemical sector. We have selected this topic because from last 3 years, during our several meetings with investors and also the wealth managers, we have been early identifier of specialty chemical as a space in equity market. We have identified, for example, companies, few of them we continue to hold, few of them we already exited after making good money. Say, for example, Balaji Amines, we bought it at below 400 levels and we exited when stock became almost 7 or 10 times from our purchase price. And of course, there are companies which we continue to own, like companies like SRF, Viniti, RP, and many more such things. So we thought to take it as a special session for about maybe 10, 12 minutes, 15 minutes, whereby we can talk about how we look at specialty chemical sector, what is our investment evaluation framework, and what kind of opportunity we see in the sector from here on, because sector is already rewarded handsomely and done extremely well on the bourses. So with me, is joining my colleague Amar Moya, who looks after the research and investment here, and he will give you more insights into specialty chemical sector. Amar, over to you. Please unmute yourself once you start. Thank you.
Thanks a lot, Rajesh Bhai, for this opportunity. So let's do the deep dive into the specialty chemical sector. Now, if you see the Indian chemical or the chemical industry value chain, we bucket the overall chemical industry value chain into largely two buckets. One is feedstock, bulk, and commodity chemical. So these are the basic chemicals which are used for which are used by the specialty or intermediate chemical as a building block. And second is the intermediate and specialty chemical business. Both these buckets have a very different characteristics. So if you see the first bucket, that is feedstock based chemical, they are largely high volume and low value businesses. They are competitive products where the setup cost is very high and the energy cost requirement is very high, and these are largely produced on a global scale. Whereas on the other side, if you see the intermediate and specialty chemical business, which is more of a niche product, differentiated technology, and they are not produced in a larger quantity and fragmented market. Because of the global competition, normally the feedstock or the bulk chemical or basic chemical have a slimmer margin versus a specialty chemical business which enjoy a higher margin because it is more customized, more differentiated, and more technology. Now, in a basic chemical and commodity chemical business, the process and the cost competitiveness plays a very important role because that brings a large moat into the business because you are competing with a global scale. Whereas in a specialty and intermediate business, R&D plays a very important role. Formulation and innovation plays a very important role. So focus is not on the reduction of cost. Focus is more on the innovation and R&D. So human capital is the most important capital in a specialty and intermediate business, whereas the capital cost is most important in the bulk and commodity business. Now, as the nature goes bulk and commodity, these are produced in bulk quantity, so they require a continuous manufacturing process. Whereas intermediate business or specialty chemical business are always produced in batches because they are largely produced on customer demand. Now, how we differentiate, the commodity chemical versus specialty chemical. One more thing which is very important, how we differentiate between the commodity and commodity and specialty is the number of steps required to produce any particular chemical. So largely what we had seen is that anything from the feedstock or the basic raw material to, let's say, 1 to 4 step is largely a bulk or commodity chemical. And 4+ steps are largely a specialty chemical. So this is also a very important parameter to differentiate between the commodity and specialty chemical. Because why this is very important, in today's last 2-3 years of rally, many of the commodity prices had gone up and there is a lot of confusion between the mind of investor that what is specialty and what is commodity. But ultimately, as I had said, a lot of these commodity chemicals are linked to global prices and global supply chain disruption has happened in the last 3 years. A lot of these chemical prices had gone up. So probably going forward, once this supply comes into the system, we will know the real nature of this all so-called commodity specialty and the real specialty. So this is very important for our identification purpose. Next slide, please. Now, this is just to give a gist about, what are the called bulk and building basic chemical and what is intermediate and specialty. So largely, if you see, all petrochemicals are bulk and commodity chemicals. And largely the basic chemical like soda ash, caustic, chlorine, which are required in a bulk quantity, phenol. These are also called a basic chemical. Whereas in terms of the intermediate and specialty, all the agro intermediates, pharma intermediates, API, plastic chemical, rubber chemicals, automotive chemicals, additives, food additives, these are largely called as specialty chemical, and these all chemicals require 4+ process to be produced. So based on this whole identification, we had also differentiated the companies. So largely all the oil marketing companies falls into the feedstock chemical. Then companies who are largely into the petrochemical business like Reliance is also a part of a bulk chemical business. Deepak Nitrite, who is the largest producer of phenol, is a part of a bulk chemical business. Largely the companies like SRF, Naveen, ME Organic, Eevee, Fine Organics, which are into more batch production, are largely called a specialty or intermediate kind of a business model. Now, one more thing, like, we are talking about specialty, but one interesting number which I'll throw is that 80% of the global market is dominated only by the bulk chemical, whereas only 20% is specialty. So it is important to know that we are going to talk and focus about the specialty part of the business, which is 20% of the business, because that is where the India competence lies. Because India was never into a large mass game. India was always into a niche customer-centric business model. Whereas China is the dominant center for this bulk chemical, and it will remain. Now, as I had said, Indian specialty chemical industry is growing to be a fastest growing industry in the world as compared to many countries and many regions. Now, along with that, as Rajesh Bhai has already covered about the China Plus One strategy, and which is also a very important theme for us. Now, why China Plus One, and what are the advantages India have specifically into the chemical business of the China Plus One strategy? So if you see the export incentive, which was almost around 12 to 13% for China versus India, which was 3 to 4%, has came down to the level of 3 to 4%, which is very similar to the India. Similarly, the labor cost, which was like 10 to 12K, has increased to 20 to 21K for China, whereas in India's case, the labor cost is still 10 to 12K. So the labor cost has gone very, very sharp in China versus India. And an electricity cost, which was significantly lower for China, is now at par with India. Along with this, India also enjoy few more advantages, like, for example, the infrastructure. Infrastructure is developing very fast in India. India has a good human capital, skill, trained laborers, engineers are available. And along with this, India also has a very good IP protection, which is probably lacking in China. And on top of this, the government initiative of PLI as well as the chemical policy of India is also going to bring more impetus to this particular sector, and India can emerge as a more competitive player versus the China and the global. So basically, China Plus One is nothing but, every global MNC purchase manager is looking for alternative, and India can be a very big alternative against China because India has a scale which probably other Asian companies don't have. So the scale will also be a very important factor to prefer India versus any other player if they are trying to replace China. Now, as I had said, India will be the growth center and the fastest growing. And what China Plus One can do to overall chemical industry is this. If you see today, the China's overall chemical industry size is around about $200 billion. And India's chemical industry size is only $32 billion. So which is just a 4% of the global specialty chemical industry and 14% of the China's overall specialty chemical market. As I had said, India itself is going to grow by 12%. So that is the organic growth which India will grow. And even if the 10% shift from China to India happen, which is around about $20 billion or $25 billion, then the India can actually double its specialty chemical market in next 5 to 7 years. So the India's share to the total global specialty chemical market can reach to 10 to 12%. This number of 4%, which is today for India, is the same number which China was having in 2020. In 2000, the China's share in the global specialty chemical market was only 6%, and it reached to 36%. So India from 4% can very well reach to 12 to 13% in next 5 to 7 years. And if this happens, this will be an enormous growth for the overall specialty chemical industry of India. Next, please. Now, when we are so much upbeat about the overall specialty chemical growth story, here comes a very important topic. What is the investment framework for specialty chemical companies evaluation? So, this is not a sacrosanct framework, but with our experience of 5-6 years in the stock picking of specialty chemical and my experience of 15 years in the industry, these are the kind of parameters, if you follow, this will help us to inculcate a good, strong, robust business model in specialty chemical. So I'll just go one by one and explain what are these whole 9 scale is very important, not on for company to become a cost competitive, to win the confidence of the customer, because any company which is trying to pose themselves as a China plus one strategy, they should have some scale or size. So not a very small company which will be preferred by a large MNC company. They want to depend on something which has a scale and size. So scale is very important if you want to pose yourself as a China plus one. Second is a backward integration. Backward integration is a very well discussed topic probably in last 3 years, because as the China supply chain issue started. So backward integration is important, that how much dependent you are on the outside market, or whether it is in India or outside India. So availability of key feedstock is the important factor for any company to become a winner in his own chemistry. Then the product purity. Now product purity varies from company to company, because as I like to share that chemical is not like a homogeneous industry where biscuit company or any FMCG company or any automobile company where the product characteristic remains same for one company to another company. Here the chemical is very dynamic business model. Like for example, SRF is into fluorine, Navin is into fluorine, and GFL is also into fluorine business. But the characteristic of these 3 businesses are very different. Like SRF is more into agrochemical, Navin is more into pharma, and GFL is more into plastic additives business. So PTFE business. Same dynamics of the business model. Now this is about the same chemistry. Similarly, every company is having a different chemistry and different industry dynamics. Like for example, Aarti is into benzene, Vinati is into toluene and benzene, Atul is like a mini BSF. So he is almost into every particular business model, right from bulk chemical to specialty to ultra specialty. So when I say the product purity will vary different for different particular businesses. Like for example, any company which is into pharma or is into a food additive business, which is linked to the human body, which is going to be consumed by human body, product purity is the most paramount thing. Whereas if something which is an agrochemical, probably the product purity is less important, but the efficacy of the product and the application of product is most important. So product purity varies from business to business. Then the forward integration. Forward integration is equally important like backward integration. Forward integration brings more margin to any business. As company is moving from as I had said, once you move from +4 steps, meaning you are moving more towards specialty. And just to tell you, majority of the companies which we own in our portfolio are at least more than 7+ steps. And in fact, few of the companies are having 12 to 13 steps process. So basically, forward integration means more premium margin, more customized product, more to the made to order business. Cost competitiveness. Now, cost competitiveness is also very important, as the scale is important, because when you are competing with a global player, cost competitiveness is a paramount. Long-term contracts. Long-term contracts bring two things to business. A, as an investor, it brings a lot of revenue visibility. B, what I see is that this also shows that what kind of confidence a customer is having on a company. Because somebody is giving you order for 10 year and 5 year and 7 year also indicates that, you know, what kind of nearness you have with your customer. So this is very important parameter to understand what kind of relationship a company has with his customer. And patent and R&D. As I had indicated from the very first slide, that specialty chemical is a human capital business. So R&D and patents, copyrights are most important things, and they are the integral part of any specialty chemical business. Then the complexity of the chemistry. As I had said from the very beginning, that complexity of the chemistry, like for example, fluorine. Fluorine is a very reactive chemical. And it has the highest reaction point, and once it reacts, it generates a lot of heat and a lot of pressure. So handling that kind of complexity is required a lot of experience. That is why there are only 3 fluoro specialty company in India. Out of that, you know, one is SRF, which we own, second is Naveen, which we own, you know. And then similarly, like for example, benzene. If you see the complexity of the benzene and the way Aarti execute benzene from the basic benzene processing to the 12-15 step process, that is very complex. Similarly, in the kind of reaction they does, like for example, hydrogenation, alynation, chlorination, which is done, these all are high pressure chemistry, which requires 9+ kind of pressure ability to handle. So in this kind of businesses, complexity of the chemistry is important, so that, you know, people cannot replicate you fast. I mean, there is nothing called protection, but at least if a replication is little bit difficult, it creates some edge to the business. Then the customer approval. I mean, as I had said, specialty chemical business is more like a made to order business. So all the chemicals which are produced by any specialty chemical company, that is approved in the R&D of the customer. So customer approval is the most important parameter, and as many number of customer approvals, as many numbers of customer approvals in pipeline indicates the company's pipeline for future product. So that is also a very important parameter to work on. Now, based on this whole parameter, what is the outcome? So for outcome for us is, what we believe here is that there are around about 200 in chemical companies which are listed on stock exchange. Out of that, we believe there are only 65 to 67 companies which are kind of classified as a specialty chemical companies. And in that, we broadly own 6 to 10 stocks in various schemes. Like for example, 6 stocks in our AAA IOP scheme, and then another 3-4 stocks in our various schemes, small cap, mid cap, and other digital portfolio, emerging portfolio, and others. So just to explain, Rajesh bhai, next slide. Yeah. So what we had done is that basically we had created a portfolio company scorecard. Now, as I had indicated, that all these 9 parameters may not be equally applicable to all the companies, but they are certainly very important and integral part of our evaluation framework. And based on that, we internally come with our internal score that where this business model is, in the scale of 1 to 10, where it basically fits. So as I had said, for SRF, scale is important. Why scale is, what is the scale SRF enjoys? So SRF is the fifth amongst the top 5 global companies in terms of the fluoro specialty chemical. Along with that, SRF has the range of R gases, which probably very few companies globally have that. Even the innovators don't have this kind of range what SRF has in terms of the R gas. So right from R22, which is in Montreal Protocol, R32, R125, R407, and various blends. And not only this, SRF also has a technology of 1234YX, which is a patented technology at this point of time, right? So SRF dominates 50% of the R gas business in India, and probably top 4 player globally in the fluoro specialty and fluoropolymer space, fluorocarbon space. And just to give you one more interesting thing about SRF. So not only in the chemical business, but SRF's characteristic is always to become a number 1 in whatever business they do. So for example, in packaging business also, they are the number 1 player. In technical textile business, they are the number 1 player. R gas business, they dominate 50% market share. And in the specialty chemical business, if you compare the fluoro specialty chemical India business, they dominate 70% market share. So this is the prominence of SRF in scale. And as AAA and Rajesh Bhai keeps on highlighting 3M approach, market size, market share, margin of safety. So market share is very important, and that is also embedded in our evaluation framework of scale. Similarly, if I talk about the Aarti, so Aarti is one amongst the highly competitive company in terms of the benzene chemistry. So out of the 200 products which Aarti produces in India, all the products are from 1 to 5 scale. They are like number 1 or number 5 in all the chemicals which they produce in the benzene space. And they dominate almost 50 to 75% market share in overall benzene chemistry. Along with that, they are now increasing their prominence in the toluene chemistry as well, and they are probably the first or second in India. So scale brings a very important competitive advantage. And like backward integration. So what is backward integration for SRF or for Aarti or for Naveen? So for Aarti or for SRF, if you see what SRF buy from the open market is only fluorspar. What Aarti buys from the open market is only benzene. That is the feedstock which is given by the OMCs. Rest everything is produced internally largely by the Aarti. Obviously, there are few other chemicals, small chemicals may be bought like nitric acid and all from the local market, but they are all locally available. So the advantage of Aarti is that all the large chemicals which they required are locally available. So any global company who is looking to give large order to Aarti, he can show that I am not dependent on China. All my raw material are produced internally in India, and that is produced in abundant quantity. So I can be a dependable player for you against the China plus one strategy. So that is why backward integration is most important. When I said product purity, now product purity, as I had said, for a functional chemical or for agrochemical is not that important. But when I say for Vinati, because Vinati supplies IBB, which is used in ibuprofen, the purity of IBB is very important because it is consumed by human body. When I say fine organics, the additives of the fine organics are used in cakes, biscuit, pastries, and they have Nestle as a client, they have HUL as a client, they have a Parle as a client. So for them, the purity is the most important thing. Then the forward integration. Now, as I had said, SRF, Aarti, Naveen, Vinati, Fine, and Atul, they have the basic building blocks internally, so they are handsomely backward integrated, and they have the continuous process of increasing their forward integration. So right from 7 step now to 10 step to 15 step. In fact, few of the SRF chemicals have 15-step process. So that is the kind of dominance they enjoy. And that is the reason globally they are increasing their market share. Same is with Aarti. And now patents and R&D. So patents and R&D is, as I had said time and again, that specialty is a human capital based business. So patent and R&D, with why R&D is required. Say for example, you are pitching to a large MNC like Dow or BASF, and they are trying to use your intermediates into their R&D. What is the role of the Indian R&D? That how to make that product better. As long as we don't have our internal R&D team, how we can make the customer's product better? So that is why patent and R&D is the most important thing. What is patent? So largely Indian companies will not have any innovative patent, but they will have process patent. So for example, any product which could be produced in 15 steps, Indian company will say that I can produce this in 10 steps, and that is my process patent. So similarly, many of our companies had applied for their process patent on a continuous basis. Now, cost competitiveness. As I had said, cost competitiveness for SRF is what? SRF is the largest producer of R-gas in India. That is their cost competitiveness. So they have that scale to produce at a price where they can compete with China, at the price where they can compete with Korea. Aarti, like for example in ONCB, PNCB and PNA, which are the bulk chemical business of Aarti, they compete with China and they are handsomely ruling the market share. Like for example, Vinati ATBS, they enjoy a 67% market share globally. How they can enjoy? Because they are cost competitiveness, because they can produce that ATBS with a zero discharge. That is there, that reduces the cost, because discharge has a treatment cost. If you don't have any discharge and any effluent, that is your cost competitive advantage. Okay, then the chemistry complexity and the customer approval, which I had discussed, in further slides. So next slide, please. So scale, size, I had explained. Customer approval, I had explained. Complex chemistry, I has explained. Forward integration is also very well explained. So this is just a kind of a case study, how we use this framework and how we had used this framework in SRF. Next slide. So thanks a lot, Rajbhai. I'll hand over to Rajbhai.
Great, Amar. Thank you very much. Guys, as you can see, Amar is a passionate chemical follower from last almost, I say 15 years. So I think good time spent by Amar for making it as easy as possible to make it less technical for the investors. Just to conclude, I will just take the next 1-2 minutes in terms of performance, where we stand. So this is our flagship AAA India Opportunity PMS plan. Last 10 years, we have delivered 22.7% compounded returns. And as you can see, 1 year, 2 year, 3 years is in front of you. 36% on 1 year basis, 29% on 2 years, 20% on 3 years, and 18% on 5 years. Our focus plan is also doing reasonably well over last 1 year, 2 years, 3 years, and 5 years. It is delivered 18% compounded return on 5 years and 21% on 3 years, 26% on 2 years, and 29% on 1 year. As you are aware, we launched AAA mid and small cap PMS plan in 2021 for first 3 months because it was still under the investment mode, deployment mode, but it did extremely well. despite holding good amount of cash. On a FYTD basis, the plan is delivered 40% compared to benchmark 34%. Why I'm emphasizing on FYTD, April to December, because January, February, March, we were under invested, as you can see under the cash levels. So disclaimer, very important. All the companies what we have mentioned, we may or may not be holding in for our PMS clients or in personal capacity. So this is not a recommendation. Kindly note this disclaimer. This is a few awards, the recent awards what we have got from APAC as well as from Silicon Valley and PMS AIF, the second year in a row. So that's it, and thank you very much, for giving a valuable time in this beautiful evening, and wish you again the great festive year, festive season. And now I will open it for question and answers. Amar, you might have got number of questions on your Q&A panel, so you probably can ask me question one by one, and I will try to answer in as much details as possible.
Sure.
Thank you, friends. Thank you very much once again.
Okay. So Rajesh bhai, should I start with the questions?
Just a minute. I'm also getting it here. So let me first answer that, and then you can also take it up. Yeah.
Sure.
First question is, upcoming large LIC IPO may impact effect on market. Well, I don't think so. I think it will be good for market because LIC will be one of the largest IPO. It will further broaden the market. So particularly, I do not see any reason, any negative impact of LIC IPO in the market. And the second question on my screen, on my personal chart, what is your view on newer worry over balance sheet unwinding by the Fed? And add to that, India government has a foreign currency debt maturity of about 250 billion, which is due in next 12 months. Govind, would you like to answer this question?
Sure.
Should I repeat the question for you, Govind?
No, I heard that.
Okay, super.
I heard that.
Okay.
So first thing first, unwinding the balance sheet. From April onwards, there will be no further liquidity infusion. So there is no withdrawal happening. The fresh in 2012-13, which is called paper tantrum, there was liquidity withdrawal also happened, which market did not like. So here, the fresh infusion will stop. The money which $10-12 trillion, which Fed and European banks have pumped in, that is likely to remain in the system. That's one. European Central Bank is still continuing with its, the capital or the liquidity infusion. So Japan is also still continuing with its liquidity infusion. So globally, liquidity is not getting unwound suddenly. From that, we are liquid words, we are not so much worried. As I have mentioned, more important is the interest rate scenario. So interest rate scenario, we have discussed at length, and in the initial period, market likes this at a certain level, and we have seen how Nifty has performed. What we have to watch in future, in case the Fed announces to reduce the liquidity, that's where market, that could be temporary, market may take a knock, but again the fundamentals starts to play. So not so much worried about that. On your second part of the question about $250 billion of repayment, while we are not sure about the figure, whether it's rupee or dollar, I think it must be rupee. If it is rupee, then it's not a big amount. It's just $3-4 billion. And as you know, India gets $40-50 billion FDI and in the capital form in every year now. So that's not a big number. So we are not so worried about that as well.
Thank you, Govind, for your answer. The next question is, what do you think about textile and sugar sector, which you don't own in portfolio? So friends, yes, textile and sugar, we currently do not own in portfolio. I think India is going to do well across various sectors. So when you look at China plus one opportunity, it is across number of fields. For example, specialty chemical is one, agrochemical is one, textile is one, API is one, electronics is one. And the best of it, kind of opportunity, what we see from the growth perspective, that's where we have selected the opportunities what I've talked about, like for example, specialty chemical or electronic exports. We have not yet basically taken exposure into the companies which are to an extent commodity in nature. Many of the textile companies are actually commodity in nature, bearing one or two companies. And sugar, of course, is hardcore commodity. And as you are aware, we do not buy the companies which are into the commodity. The next question is for Amar. Amar, the question is, can you share the difference between SRF and Naveen Flooring?
Yeah, thanks a lot for this question, and it is very interesting question. I think I briefly touched upon while discussing it that, three companies started the journey at the same time, like SRF, Naveen, and Gujarat Fluorochemical. But whereas if you see the outcome of all these three companies are very different. So what now broadly just touching upon the question of SRF versus Naveen. So one big difference is that even though they both are into the fluorine chemical, SRF is largely dominated by agrochemical. So if you see SRF, 4-5 large innovators, agro innovators are their client, and they have a business which is linked to their R&D, as well as they have the chemicals which are commercially used by the innovators. Whereas if you see Naveen, the very big difference is that they have the CRAMS model and they have the specialty chemical model as well. In CRAMS model, majority of the chemical which they are supplying today, they are supplying to the pharma companies. And none of these pharma products are commercialized yet. So they are either in the phase 1, phase 2, phase 3 of the trial. Now, because these are R&D based chemical, they enjoy a very high value into this. Secondly, the specialty chemical business is also 50% pharma and 50% agrochemical. 50% pharma is largely domestic linked and 50% agrochemical is international linked. So just to differentiate between SRF and Naveen, SRF is CRAMS, which is pharma, which is more R&D linked. Naveen is more pharma and R&D linked. SRF is more agrochemical linked. This is a big difference. Then there are a lot of other differences between the management. As I had said, SRF management is a scale and growth focused. Naveen management is more ROC focused. So whatever decision they will take the decision based on the ROC. So that is why if you see incrementally their high value business in the portfolio is increasing versus the commoditized organic fluorspar business and R-gas business. That is the reason they lag behind in R-gas. So they only have R22. So there are various differences. I can discuss this for 30 minutes, but just to sum up, these are the broad differences.
Great, Amar, thanks. Let me also just add to what Amar has said. While of course there are differences, we own both these companies, SRF and Naveen, and SRF I think has probably became 4 times or 4.5 times from our purchase price, and Naveen is probably 3 times from our purchase price, and we remain positive on both the companies we own in our portfolio. Yeah, Amar, you can now start asking question one by one, because I see a lot of question here, and it would be great if you can just ask question, and I will try to handle.
So just to start with the first question, what is your view on banking sector? The sector has underperformed majorly, and do you see the sector to bounce back?
Good question. I think I already covered in my presentation that banking sector went through the painful time in last 12-18 months because of the COVID related issues. The SMEs are under pain. The credit growth is yet to bounce back. So the loan book growth is still not that high, correct? The good part of banking from here on is that as the economy starts doing well, the credit growth will pick up, number one. Number two, most important, the asset quality issues are behind you. Number three, the credit cost will remain under control. Number four, the provision coverage ratio has already increased significantly. Combination of all these things, that means from here on, you will see growth as well as improvement in ROE for the top banks I'm talking about. As I said, in banking sector, our approach is winner takes it all. So we are holding only the top 5 institutions in the country, correct? And that's where it's going to be very, very stock specific approach. The valuations now are in your favor. So I think from here, the sector should do reasonably well over next 12-18 months.
Okay, so second question is, sir, which are the sector on which you are bullish?
Okay, the sectors on which we are bullish, First, of course, I say China plus one. So we are bullish on specialty chemical theme. We are holding roughly 8% of the portfolio in specialty chemical. We are also positive on electronics exports, roughly 2.5% of the portfolio. So China plus one is roughly about 11 to 12% of the portfolio. Second important theme on which we are positive is the capex, revival of capital expenditure, and that means buying very selectively. Again, I'm using the word repetitively. Be very, very selective in your stock selection approach. So we believe that capex related companies will do well, but I'm not talking about infrastructure companies. I'm talking about companies which are strong R&D, product, technology, innovation as a mode. Third sector on which we are positive is the consumer discretionary. I already talked about it. We believe the consumer spending is going to increase. Discretionary will do well. Along with that, the building material will also do well. So that is about roughly 17 to 18% of the portfolio. Fourth important thing is companies which are globally competitive. So for example, Sundaram Fasteners in auto ancillary, it will benefit immensely, not only from global auto recovery, but also from the domestic commercial vehicle recovery. So we are holding Sundaram Fastener. Similarly, Craftsman Auto, we believe it is going to do extremely well because of the domestic CV recovery, as well as their special focus on the value-added segment of the auto ancillary. So again, within auto and auto ancillary, this basket overall in the market has not done well. So we believe there are sweet opportunities to play in auto and auto ancillary, and so on and so forth. So this is broadly are the list of sectors on which we are positive.
Yeah, thanks a lot. Now on the specialty chemical, the sector valuation has moved up a lot. So do you see the opportunity even from here on?
Can you repeat the question, Amar? Sorry, I missed the question.
So I'm saying this is about the specialty chemical. The question is the valuation has moved up significantly. So what is your call from here on in terms of the sector outperformance?
Very good question. I think entire chemical space in general has done extremely well in last 12, 18, 24 months in the market. More importantly, the commodity chemical stocks have actually done significantly better because many commodity chemical prices are at lifetime high levels. They went up by 200, 300, 500%. So you can imagine kind of a profit growth for these companies. We believe from here on, the specialty chemical companies will gain more traction. Yes, the valuations are no more cheap. When we bought, probably they were trading at 10 times, 12 times, 15 times. Now they are trading at 25, 30, 35 times. They are no more that attractive. But when you look at the growth opportunity ahead, let me tell you, for example, our entire portfolio companies, whether it is SRF, whether it is RP, whether it is a Naveen, whether it is a Vinity, or whether it is a Fine Organic, they all are likely to report 20 to 30% compounded profit growth. If I look at their capital expenditure plans for next 5 years, that provides you strong visibility that what kind of revenue these companies can clock because they have got such kind of a customers inquiries to their plants. Am I right? So these companies are going to be a hyper growth orbit. Amar has briefly talked about it that 20 years back, China was 6% of specialty chemical industry, and today it is 32%. India is today 4%. 4 to 10 to 15 to 20 to 30% is the journey. And that journey will be having only few large players as the winners, which will grow 20, 30% compounded. They'll be probably doubling their profits in 3 to 4 to 4.5 years. And from there, the free cash flow will then start. So I think the opportunity is still very big. The valuations are expensive, but they are justified given the technical competence, given the scale, given the market leadership, and strong growth over next 3 to 4 years.
So next question is, do you participate in new age digital companies?
Yes, we look at every company. We all are learning. These digital companies have been evolving. Their business models are evolving. We are very, very particular where to participate and where not to participate. So we do not want to chase the momentum. So we are very, very selective about digital companies participation. We believe that digital is going to be a very big opportunity for India over next decade. It is not a 1 quarter opportunity, it's a next decade opportunity, but you need to be very, very selective what you are buying within digital. So we are holding few companies in our portfolio, which are market leaders with a great balance sheet, great governance. Very importantly, it is a profitable company. And I'm talking about, FS and e-commerce, Nykaa. That's what the company we own. Otherwise, most of the other IPOs, we have given a skip. And we'll keep evaluating if there are any opportunities, definitely be looking into it.
Now, next question is, sir, I had invested in a mid and small cap. and I'm very happy about the performance. Can you tell us how do you see large cap versus mid cap and small cap in 2 to 3 years?
Good question. But I'm sure most investors would be aware. We opened the AAA PMS mid and small cap plan. We launched it in January. After that, market moved up a lot. So we actually closed the PMS plan for any flows. We were taking only SIP and staggered. We were not taking any lump sum. Just about 25-30 days back, we have reopened the PMS plan because that time market has witnessed a good correction, particularly in mid cap and small cap index. So I think very importantly, first of all, let me draw to your attention. We do not own any company across our portfolio, companies which are small. We buy only the big companies. The market cap might be small, but the company must be a leader, and we continue to follow our 3M investment approach. All our companies, even within mid and small cap PMS plan, they are gaining huge market share because they are number one players in their respective industry. And we believe that tailwind will continue. Our portfolio is expected to report 25% plus earnings growth in FY22 as well as in FY23. So I think we are on a very, very strong wicket. So I do not want to give any generalized comment, large cap versus mid cap versus small cap. The company should be big. And that's the mantra what we continue to follow. And I think one will continue to deliver probably good performance from this space as well, provided the companies are right.
Okay. Now the next question is, sir, most high quality company valuation has run up a lot. So how do you see the risk to the valuation?
Yes, I think that's a very important question. Valuation are not too cheap, but at the same time, let me tell you, valuations are not too expensive either. So if you look at the Sensex valuation or Nifty valuations, they are trading at about 10 to 12% premium compared to last 10 years average valuation. So, generally लोगों को लग रहा है कि valuation बाजार का बहुत बढ़ गया है. लेकिन अगर हम 10 साल का PE से compare करेंगे, तो market valuations are up only 10 to 12% compared to its 10 years average. Now you look at the earnings growth journey, when you look at the lean balance sheet of corporate India, because they've reduced the debt a lot, I think these two factors with the lower real yield as a third macro factor, I think these valuations are justified. So I'm not too much worried about valuations. What can be the risk to this valuation is the growth. If the growth doesn't come, then definitely that will be the biggest risk to market. And that's why, again, be selective. That's very important. Market may give you positive or negative surprises. Your portfolio companies need to be resilient enough so that they can absorb any such volatility which may come into the market.
Now, the most important question, what are the budget expectations?
Well, we do not have any budget expectations. I think it is an event. Every year that event comes and event goes. But if you ask me, yes, it creates a little bit volatility into the market. There are two events from market perspective. One is budget and second is UP elections. Both these events may lead to some volatility. As I said, take it to your advantage. Don't think beyond a point. So we are not too much worried from budget perspective. I think this government is taking decisions which are on the reform path. They are taking most of the decisions which are sensible in nature. They are keeping in mind the long-term interest of the country. The capex is a classic example. If you look at the capital expenditure done by central government and state government, they have seen 20-30% growth compared to a normal year. So it means they have a willingness to spend, correct, to revive the economy. The interest rates remains low. The RBI policy remains very, very SME friendly. So I think all the right steps are taken by government as well as the bankers. So I am not too much, worried about it. I don't know, Govind, if you want to add anything to this.
No, I think Rajesh, you have covered last 5-7. Can you hear me?
Yeah.
So if you analyze the government actions over last 5 to 7 years of this government, it has been very, very systematic, and now it has been one of the best performing currencies relative to many other currencies. I'm sure
Govind, your voice is going. I think you are in a poor network.
know this is will the oil import will. I'm India's. Can you hear? Hello.
No, I think your
So maybe
network
some.
strength is very low. No worries.
Okay.
Let's
Fine.
move
So
to the next question.
go ahead then. Forward. Yeah.
Do you see any major negative impact of COVID-3 on market?
As of now, I don't think so. And I think probably we are moving from pandemic to endemic. If you look at the global rate, hospitalization rate, level of oxygens, across the world, the reports are showing no such major dangers. So I hope and pray that, the health of the citizens remains by and large good. So I do not see as on now any major impact on economy and therefore no impact on market.
Should I take few more?
Yeah, Amar, as many, whatever questions, please go ahead.
So what is your take on the EV opportunity for EV electronic opportunity, and primarily from the context of chemical companies?
Amar, you can answer it.
Yeah. So basically, see, EV ecosystem, as we know, is emerging and evolving in India. As such, there are no clear-cut beneficiaries, but few companies who had announced their capexes, like for example, Gujarat Fluorochemical, who had announced their capex largely for the electrolyzers, which is going to be used into EV batteries. Similarly, there are talks going on that few of the commodities like graphite, lithium ion, there will be few companies which can benefit because of this, but there is no clear-cut answer to this. It is just, everybody is trying to do their guesswork. So I would not recommend any particular company that, who is looking to be a prime beneficiary at this point of time.
Super. Next, please.
Yeah. Do you find the risk reward favorable in some of these fluorine chemistry companies?
I think we have already covered it. We have talked about it, that we have a long earnings growth ahead. So we are not worried about valuations perspective. As I said, all of our portfolio companies, including specialty chemical companies, for example, SRF is likely to report 26% compounded earnings growth over 3 years. And same is true for our entire chemical basket. So therefore, the valuations are justified.
Okay. Now, one question is for me. Thank you for the wonderful session. I think the government has put some anti-dumping duty restrictions on few fluorochemicals, especially fluoropolymers, for next 5 years. Will it be the beneficiary for the companies like GFL? So yes, companies like GFL will be benefiting because of this anti-dumping duty. And just to tell you, any which ways also, Gujarat Fluoro is the largest and the only producer of fluoropolymer in India. And he dominates Indian market, and along with that there is an anti-dumping duty of 5 years for China by US, so they are also getting benefit of that as well. So you are right, they will get benefited out of this.
Okay, the next question has come to me in my box. What about the EV future concept in auto industries? This is a very good question. Friends, the auto industry is of course changing from the traditional to the EV play. How we are looking at it is that while the segments are still evolving, it is because nobody has driven the car for 10 years and nobody knows the replacement value, right? So industry is still evolving. There are two ways to play this. One is play through OE company, two-wheeler company, four-wheeler company, truck company, or other is to play through the auto ancillary sector. And we believe that auto ancillary is a better play to play not only this EV, but there are many more such new regulations, the change in the consumer behavior. For example, content per vehicle is increasing. Number of sensors are increasing. Number of seat belts, number of airbags, safety norms. For example, every two-wheeler requires a smart key and many more such things. So we have identified the auto ancillary sector, and we are holding the companies in all our PMS plans, which are going to get benefit out of this EV. Most of the companies which we own, they are actually neutral to irrespective of whether it is a IC engine or it is a EV, but they are bigger beneficiary because of the higher scope of content per vehicle. So I've talked about, for example, a company like, for example, Minda Industries. Now this company is reported, probably the profit grew by almost 5 times in last, 6-7 years. Is the largest beneficiary of changing trend in automobile industry, whether it's EV or non-EV. Their capacity of alloy wheel plant, for example, has almost doubled, correct? They are beneficiary because of the airbags, is a big beneficiary because of that. There were a number of technology collaborations to take benefit of the emerging trends into the technology, into the automobile, and so on and so forth. So yes, that's how we are playing the auto and auto ancillary.
Yeah. So couple of questions on chemical again.
Yeah.
So, the first question is that the chemical companies that has come with IPO in last 2 years, like Anupam Rasayan, Rosari, Cleantech, do you see any interesting play into there?
See, basically, every company, as I said, we evaluate in our investment framework, and we cannot buy everything, am I right? We need to always compare A over B. When we compare A over B, it is about the moat in that company. What is the sustainability of the growth? Very important. Amar has already talked about the 9 points framework, and we rate the company on each of these 9. This is just the qualitative framework. Of course, it will take another probably 1 hour to discuss the quantitative framework, which includes the gross block addition, the capital expenditure, last 5 years, next 5 years, the growth, and many more such things. And after combining that qualitative factor and quantitative framework, we identify the companies which are better on risk-adjusted rewards. I repeat again, what is the upside? What is left for you on table is important. If you're buying a company with a 65 PE, and if it is a specialty chemical company might be a great company, but with a 65 PE, with a net profit of 100 crores, we would skip that company and we prefer to buy a company with a maybe 35 PE or 40 PE or 32 PE, but with a 700 crore net profit size and a sustainable earnings growth of 20 to 30%. So not that this company, what you mentioned, are not good. Every company is a good company, but it's all about the relative valuation and the relative growth opportunity. Based on that, we keep evaluating. And as you are aware, we are very, very dynamic in terms of our stocks. So we do not believe that we buy and we forget for 10 years, irrespective of whatever happens in that company. No. If we believe that company is not going to grow or the valuations are full, we do exit. So we exited, for example, Balaji Amines. We bought Laxmi Organic at a post-IPO listing. We made our money 3 times or 4 times, and we exited Laxmi Organics. Correct? So we are very, very clear about what we will be doing. We'll be buying the businesses, hold on till the time there is an opportunity, exit if you believe the valuations are full or growth is not going to come or whatever the reasons. And that's the constant evaluation of what we do at our investment management team level.
Few more, should I take?
Yeah, go ahead.
So in continuation with MNC Chemical, earlier why they are not performing as Indian chemical companies, example BSF and Bayer.
Friends, every company is a different company. As I said, don't generalize the things that chemical is good, it means buy every company. No. There are a few companies which you mentioned here. While I don't want to give any specific company-wise answer, the one of the company which you talked about has a 100% subsidiary as well. Now you don't know the next capex will come where, in the listed entity or unlisted entity. Number one. Number two, the one of the company which you talked about or you asked in this question is 75% of the business is commodity chemical. It is not specialty chemical. Now whether they do well or not, I am not going to look into it because they are into 75% to 80% of the business is commodity chemical. If the commodity price will do well, the stock will double. If they don't do well, the stock will become half. So I skip that. As far as the other company which you talked about, which is into agrochemical, I think is a formidable player in Indian soil and definitely is a company which is a fundamentally very solid company. The only challenge when you buy such companies is that you are buying only domestic growth opportunity. So for example, we had another agrochemical company and they are basically beneficiary of not only domestic agrochemical industry, but they also have an exports opportunity. Moment we believe that domestic agrochemical industry is going to do extremely well, definitely we'll look into any such MNC as well who has a strong presence in domestic agrochemical industry. I hope that answers Neil's question.
Okay, now one more question. Also, your view on Neogen Chemical, do you see the Eevee play seems plausible there?
Friends, I would like not to give too much of stock specific answer because then there is a never no end to it. I can only tell you that currently we do not own that company in our portfolio, and at right time we'll evaluate it and we'll check if it is worth investing or not.
Hello, could you please talk about the selected stock picks which could benefit from the capex revival theme?
I already talked about 6 companies which we currently own in our portfolio, which are the biggest beneficiary of not only capex revival, but the biggest beneficiary of the industrial transformation of 4.0, which is happening in the world. These are the companies which are going to benefit because of the rising automation, process improvement at the plant level, brownfield capex by private sector, and of course, smart infrastructure initiatives by Government of India. So, we are already having these companies in our portfolio, and I think they'll be the large beneficiary of the trend.
Got that. So broadly, we are done with the question answer. If you want to give any closing remarks.
Just a minute. I'm still getting here questions. Okay. Just a minute. There is one question from Arvind Bhai. Your view on Suven Pharma, your portfolio old company. Arvind Bhai, I would not like to give stock specific answer. It's a great company. And I think the CRAMS, in general terms, let me tell you, the CRAMS is an opportunity on which we are very, very positive and bullish. And there are few companies in India which are doing exceptionally good job on this CRAMS business. We are already holding one company in our portfolio in CRAMS, and the company which you talked about is always the company on our top radar, because this company has also delivered great financials and a great track record of commercialization of the molecules which are under study for their customers. There is one more question. I'm getting it here. Just a minute. I think. Any more questions?
I think there is one more which I can see. Hello, Amar. If time permits, please provide your view on Jubilant Ingravia and Lakshmi Organics.
Okay. Jason, as I said, we do not want to give too much of stock specific views, but currently we do not own this company in our portfolio. One company, Lakshmi Organics, we already bought it post listing. We made our probably 3 to 4 times money in less than 12 months. And we therefore thought that valuations are probably full at that point of time I'm talking about. After that, stock is already corrected by 35% from our exit price. Company is definitely a very good company. That's why at the first place we had in our portfolio, and we'll keep evaluating opportunity. If we believe that company offers reasonable growth at a reasonable margin of safety, we may again relook at it. Great. I think that's it from the questions perspective. I'm really thankful to all of you for giving your valuable time on this evening. I know it has been Makkar Sankranti, and I'm getting messages from my Gujarat clients that Rajeshbhai patang chagawani છે અને આપણે presentation હરી કેટલી વાર ચાલશે કરે. So wish you again happy Makkar Sankranti.
Happy Makkar Sankranti. Happy
Makkar Sankranti.
And this is our AAA Investor Connect program, and under this program we'll keep doing such webinars every quarter along with our AAA winner series, whereby we invite promoters to talk with you directly. Please feel free, if you have any questions, queries, you can always send an email. Just to give you one more important thing, I'm sure you guys are aware, all our PMS plans have a STP option and SIP options. So, if anybody wants to do staggered investment approach, we have a STP options as well. With that, we will end our session here. Thank you once again, everybody, and please enjoy your holiday. And probably we'll see you soon physically once this COVID era goes away. Thank you, friends. Thank you, the entire AAA team as well. Thank you, Govinji. And
bye-bye.
Thank you, Amar.
Thank you.
For a great presentation.